This episode is brought to you by Bureau, our title sponsor. With 8 vibrant locations in Miami's best neighborhoods, Bureau is the perfect co-working place to work, network, and thrive alongside other entrepreneurs, creatives, professionals, and local businesses. Find your space at bureaumiami.com. Well, welcome back to Bureau Central, gentlemen.
Yeah.
We're here for the Q2 2025 market update.
Yeah, we got two of our favorite sexiest men in Miami. Not only are they great looking, but they're fucking nerds and they're smart. So
and Felipe means that in the best possible way.
I do, absolutely. We want to start. We want you guys to give us a little background about who you guys are, just so everyone knows.
No, you're starting wrong.
Am I?
Yeah, you already screwed it up.
That's right. I fucked it up.
Yeah. Cheers. Guys.
Cheers. There we go.
Cheers. Cheers, gentlemen. Thank
All right.
you for coming back.
All right. Thank you.
Juan convinced us all to drink some double black, so.
didn't have to do much convincing. It happened organically, I guess.
Yep, that's how it goes.
By the way, Anthony, we love your cocktail shirt. Like, he came dressed up for the occasion. He's got little martini glasses. Is that what it is on your shirt?
I'm a veteran now.
This
This is my third appearance. I knew where I was going. This is like some kind of fraternity hazing thing, like where you just drink and see how long you could stay coherent. I love it.
See when the stats start getting skewed.
Right, exactly.
But we were talking to Anthony beforehand, before you arrived, Juan. People seem to love this this market report. It's actually one of our most downloaded episodes, so we're really stoked to have you guys back. So it's great to get the perspective that you guys have, both of you guys at a national level, and then also at a local level. So super valuable information for our listeners.
Everyone wants to know what's going on.
Yeah.
We don't know what's going on.
Well, yeah, we definitely do.
Yeah, we got to have the magic crystal ball guys tell us.
Exactly.
And that's not a reference to your head again, Anthony.
Very nice. Very nice.
So Anthony, kick us off. Who are you? What do you do?
Sure. Anthony Graziano. I'm the CEO of Integra Realty Resources. We're at www.irr.com. We are a nationwide advisory, consulting, and appraisal firm, and we do real estate valuations and consulting coast to coast and in the Caribbean.
Okay.
I do love how IRR is like a double entendre, you know?
Yeah. Oh, yeah. It's pretty cool.
Yeah, I like that.
Yeah.
Internal rate of return?
Yeah. No, I mean, look, we bought that domain before anybody knew what a domain was. We bought it from I think I mentioned on your first podcast, we bought it from a little old lady in Kansas City.
Oh, that's amazing.
She
Wow.
had like a knitting company, and I was 27 years old, and all the guys on the board, when we founded IRR, they didn't know they were thinking about email, but they were thinking about like a CompuServe account or something.
What year did you buy the domain?
1998.
He's trying to date you here.
Yeah, I totally old man. Yeah, 1998. And anyway, she got real aggressive. She wanted $20,000 for it.
What'd you guys pay her?
$20,000 for it. And I told them, I'm like, go, just do it. We'll look back on that. It was the best thing we did.
That's awesome.
Wow, that's cool. Cool. And Juan, tell us about you and who you are. What do you do?
Sure. So I'm the National Director of Industrial Analytics for the CoStar Group. Prior to that, I was the Director of Market Analytics for South Florida, covering the entire region. So I've recently made a career change.
Yeah.
So I work for CoStar Group, and we basically provide analytics to all of commercial real estate. We also own homes.com, LoopNet, apartments.com. And so we provide also like listing services, portals.
Cool.
Might have some access to some data.
Yeah, a little bit.
A little bit of data. Yeah.
And Juan just got a whole lot more attractive for us because now he's doing industrial. He's doing.
I was doing industrial before.
Yeah,
it was
but
just
now,
for just South Florida.
Yeah, but now you're like full. Now you're the industrial guy at CoStar.
Yeah.
So that's super cool. It seems like the stars have aligned for our podcast now that we're focused on industrial. You're focused on industrial. So why don't we start off with industrial, I think, right?
A transition. That was great.
So I actually, since we last spoke, we did our Q1 report. There's been a lot of tariff talk. We've gone.
Oh yeah, last time we had this pod was the Liberation Day, right?
It was just Liberation Day.
Yeah.
Traffics are on again, off again, on again, off again. But the stock market keeps touching new highs. which is incredible. We had last week we had our jobs report. Came out pretty solid, surprisingly. Economy seems super resilient, and so I picked up some. Let me pull up some interesting statistics here from the Washington Post. Some would consider the Washington Post a woke newspaper, but we'll pull out some of the stats here.
We can start using your pronouns if you want us to.
I thought this was interesting. There were 25 fewer container vessels that reached the West Coast ports between late April and late May, meaning roughly 325,000 fewer containers on average reached the U.S. shores. That's a shitload of containers. And so they go on to say when such a drop happens, it ripples across the supply chain. Longshoremen don't have as many containers to unload. Truck drivers don't have as much cargo to carry. Importers have to reach into their storage for goods, and ultimately shoppers might see shortages of some products. The cost of shipping containers have also went from like $6,000, they dropped down to $2,000. It's incredible to see the volatility on the prices of shipping containers. They've gone back up to about $5,000 at the peak of the pandemic. They were going as much as $20,000 for a container, and so this has had an impact on us. I don't know if we've seen it yet on any of the actual numbers. West coast of the U.S. is where most of these containers come through. So we'll start with you, Juan. What's your sense of the tariffs? Are we starting to see any impact of the tariffs yet? And how much longer are we going to be on this roller coaster ride with the Trump tariffs?
Yeah, I think last time we were on this podcast, we talked about this, right? Like the uncertainty that is generated kind of stifles up business decisions and business expansion plans, et cetera. And unfortunately, because this is tariff related, this impacts the entire logistics supply chain, retailers, et cetera. So last time we spoke, I had mentioned that like we just need clarity. And the quicker that we get clarity, the better it is for the entire economic environment. And we haven't gotten that. We've gotten the back and forth constantly. And now we're getting letters getting shipped out to our trade partners, scattered here and there. No real clarity either there. So this on and off again situation is probably going to be with us a little bit longer than we would want. And what that has been causing so far is, like you were mentioning, is that roller coaster ride, right? So we've been on that roller coaster ride since the April timeframe, and what we saw was shippers trying to get things through as quickly as possible. So container pricing went up, then it went down as the tariff situation was happening, and now what we saw through July was the pause on tariffs got put on again. And then shipment costs went up again, some goods coming in. So if you look at the National Retail Federation numbers, their expectation is basically that we're going to get another surge in imports coming in June, July. And then after that, we're going to drop off significantly again. So the peak season's happening earlier, it's happening quicker. But even though we're reaching another peak season, the overall levels for the year in terms of imports coming in, they're not going to surpass the levels that we saw during the pandemic, right? And when you look at overall inventories for retailers, retailers remain very lean because they are very uncertain about tariffs on one hand, the consumer and the economy on the other hand. You know, you mentioned the employment report. It's very, very healthy still, but a lot of that has been government jobs in the state and local level that have been getting created and helping that number. So we haven't seen much growth in the office using sector, in the high income sectors of the economy that generate more consumption, more demand. And we've actually seen a pullback in some of the spending patterns. So the uncertainty that lingers continues to create uncertainty for retailers, uncertainty for the consumer, uncertainty for the economy, et cetera. It trickles across everything. And basically that's delaying business decisions even longer. We previously thought that, hey, we might see a resumption in rent growth acceleration for the industrial property type later in the year. Now it's getting pushed back another year because of what's happening. And I think I shared with you one of the latest articles I wrote, which is basically looking at, hey, we got, data sources differ. CoStar is showing that we have, for the first time in, or like 15 years, negative net absorption for industrial.
We had our Cafecito Club this morning, and if our listeners haven't shown up, you should. There's good people to meet and good topics to cover. But something I had never really heard of before was a bonded warehouse, and that seems to be popping up now, which is like a free trade zone, right? As goods are on their way over somewhere else. Yeah,
the bonded warehouse has been on the news lately. There's a capacity constraint there, right?
I'm sorry, can you talk a little bit about what the bonded warehouse is?
So it's basically goods get put on a ship, they get shipped over, and as long as they're within this bonded warehouse, the tariffs will not apply to them. Typically, it's for any type of good that's going to get kind of like a makeover here and then gets shipped back out, right? And we have a capacity constraint there because there's certain designations in every city of where the bonded warehouses can be. They haven't been growing significantly in terms of the designated areas. So, that has been holding up relatively well because there's been demand for that to avoid tariffs and just keep stuff in there as long as you can. But it's not like a boom that we can get from the logistics environment because there's a capacity constraint that's very significant. You can't be outside that perimeter and still get the benefits.
We haven't had a lot of need to create those areas because our tariffs relative to other countries were low. But I'll tell you an on-the-ground story that supports what Juan's saying in some cases, although I would argue that, if anything, in this last quarter, the tariffs and the uncertainty around the tariffs have actually proven to be a net positive for the economy, right? So here's the thinking. When we got to the point, the end of the first quarter, where the tariffs were about to be imposed, and we said, and everybody saw next week, everybody's going to have 50% tariffs. Immediately what happens, there's ships coming from all over the world, and those get rerouted to Vietnam, to Singapore, to the entirety of areas that have bonded warehouses, and everything gets stored. And then the tariffs get delayed, and there's an 8-week, quote, negotiation period. Everything gets unloaded from those warehouses, put back on ships, and immediately shipped here. So last week, right, Trump had this deadline, and then all of a sudden he said, oh, I'm going to extend that deadline. Let me tell you, the economic activity in the next 3 to 4 weeks, getting all of the goods that are right now sitting in warehouses into the U.S. before those tariffs take effect, is going to, again, it's almost like turning the hose on super hard, right? At the same time, we have companies here that are now evaluating their supply chain and what they're going to do, and now they're having to start to make choices about. So it's shifting all of the demand. Is there a ton of speculative demand for just general warehouse space today? No, I agree, that's been waning. But in terms of what we thought was going to happen, at least at port industrial logistics, I think it's been a net positive because everybody's positioning and everybody knows there's an economic reason for them to position. At the same time, what happens after July if the tariffs do go into effect? They're not negotiated. Now you're going to have a slowdown again heading into the Christmas season. And as Juan mentions, as we get to the back end of the year, if the consumer doesn't hold up, we have now a federal workforce issue. We had talked about in the beginning of the year, the federal workforce was getting cut, and then it was like, no, that's got to go to the Supreme Court. Well, now the Supreme Court comes back and says, no, actually the president can fire the workforce in about 7 or 8 different departments without congressional authority, and that was last week. So now let's see what the next jobs report's going to be in 30, 60 days when that's permitted, because that was a big fear factor in the first quarter as well. But at the end of the day, I think right now, the tariffs have been mostly driving some excessive level of economic activity in advance of when it would normally happen. But the difficulty is it's still the same amount of water that's coming in, right? It's just you're pouring it in quickly and then stopping it, pouring it in quickly and stopping.
I don't agree that it's been a positive. I think because of this on and off again, decisions for the long term, for continued expansion, have been delayed. And so with those decisions on hold, what we saw in the last quarter was, hey, like, yeah, tenants continue to leave older logistics properties, and typically net absorption was positive, and it was being held up on that positive side by the newer logistics getting absorbed. We saw a significant slowdown in new absorption for new logistics space. And in what my thinking is basically that a lot of that is being driven by businesses holding up and saying, hey, I'm not going to expand right now. And that's causing significant pain for the industrial segment right now because we are significantly oversupplied. Even though new constructions are down, et cetera, we're still going through a supply wave. So if you look at pre-leasing of brand new spec warehouses, it's down. If you look at rental rates, they're trending down. So I'm not too sure if it's a positive because of the long-term ramifications of what tariffs do entail. And the other side of it is, yes, you get shipments getting put on warehouses in Vietnam, et cetera. But the whole point of the tariff war was we are going to rethink our supply chains. And we are getting back to more of the same. Even though there's been a brand new deal hashed out apparently with Vietnam where there's going to be a 40% tariff hike on any transshipments. The transshipment definition hasn't been quite hashed out yet. And what we've seen, which is what we saw even prior to the tariffs, was constant reshuffling of, hey, these goods are still being made in China, but now they're going through Southeast Asia before they're getting here. And that still doesn't help the entire tariff situation. The whole point was we stop relying on Chinese-made goods. We're not changing any of that, right? So we're feeling pain with the on and off again time period, creating more uncertainty for an economic environment where we're generally slowing down. We have high interest rates. We have slower demographic growth because we're also cracking down on immigration. And we're not really solving the issue, which was we're still getting goods from China. Like that's not gonna change. And as long as you're on an all-out war with all of these countries at once, you're making them stick together more. You're not really picking a fight, a strategic fight with one player at a time. You're fighting all of them, and they're all deciding to, hey, take a step back. The first thing that China did when we went all out on tariffs in April, they went to all of the Southeast Asian countries and started talking with them and making trade deals with them, like in 1 week.
Ben, you know what they say in real estate, if people don't know you, they're not doing business with you.
Exactly. That's why the Built World podcast works with top-of-mind public relations, because being a best-kept secret sure doesn't pay the bills.
Paula Uspa Abbott, the brains behind Top of Mind PR, is a former real estate journalist, so she knows exactly what makes the media pay attention.
And let's be real, getting in the press isn't just about bragging rights. It's about building credibility, landing deals, and making sure the right people know your name.
Whether it's top-tier media coverage, killer storytelling, or just making sure you're the one people think of first, Top of Mind PR has you covered.
Want to stand out? Hit up topofmind-pr.com or email info@topofmind-pr.com.
Because in real estate, if you're not visible, you're invisible. Ben, you and I are all about PropTech, and if there's one tool we absolutely cannot live without for a commercial real estate brokerage business at Gridline Properties, it's Vista.
Absolutely. Vista is incredible. We use it every single day, and we're always wondering, how do they do this? Every evening we get an email from them with real-time closed transactions. No more waiting around for months for the property appraiser to finally update.
Yeah, whether you're doing industrial, retail, office, land deals, they have every closed transaction. And it's not just the speed, Ben. The details are on point. Seller and buyer info, contact details, phone numbers, emails, everything is accurate.
It's hands down our top prospecting tool to farm for warehouse deals in Hialeah. Vista keeps us one step ahead always. It's also the best way to search for comps when putting together opinions of values for clients.
Head on over to Vista.com and use code BuiltWorld and get 30 days free access today. VIZZDA.com.
It's interesting. You came from a particular angle. You started to say, you don't agree with me because you said it hasn't been a net positive, and then you defined it in real estate terms. You said okay, because vacancies are up and we're seeing net absorption is negative and so forth. But that's from the real estate perspective. My commentary really related from what you were saying from the Washington Post was from an economic perspective. How's this affected the economy? And generally, if the economy does well, real estate will do well, right? So we want to see the economy growing so that that supports real estate. Obviously, in all of this, there's dislocation. I agree with you that in a lot of instances where we're starting to see, slowing demand, maybe the companies are holding on making decisions or not, that's only going to be part of what I was calling that rubber band effect. They're holding now, so we're seeing that data now in the second quarter. But economically, it's good because the companies now are thinning their liabilities and they're thinning their expenses. So the companies are getting stronger by not making those longer term commitments, which makes those companies and their stock get stronger. Think about it also in terms of an economic context of the global companies. A company like Prologis may be real sad because their net absorption in the Miami market may be slightly off than what it would projected, but they own warehouses and bonded warehouses all throughout Southeast Asia, right? So they're performing in other areas of the world. I'm not arguing whether we should have a trade policy discussion. We can, but I don't know that I don't know if the intent was to say we don't want to buy Chinese goods anymore. I think the intent was to say we're going to use tariffs as a way to raise revenue in the alternative of just taxing our own people. I think that's fundamentally where it's coming from. The irony, of course, is that everybody realizes that all of that's going to get passed on to the American people in the form of pricing, right? So that's fine. It's just another way to be taxed. In any case, I think my main point was it's good for the economy. For the last quarter, it hasn't been a net negative to the economy. But we'll get to a period ultimately when those tariffs get enacted where there will then be that real contraction of trade, and that's going to be a net negative on the other side. So the question is what happens as we go into the third and fourth quarter? All we've done is sort of kick the can down the road to see what those impacts are.
I think just because things have held up doesn't mean we're not losing on one end. We have lost some growth that we would have had if the uncertainty hadn't been in place. And the concern here is that the uncertainty will be with us for longer, pushing back growth. That means layoffs. That means slower employment growth. That means lower consumption. That means that the recovery that should have happened beginning of April, where the real estate community was already thinking that, hey, the new president's coming in, things are going to be great, and we're going to have a rebound in the entire business environment, that gets pushed back longer and longer, and we're losing out on time, which would have been a time where we would have made gains, right? So,
but the counterpoint to that is that the only way that the real estate community should have really been thinking that we're going to do really well next year, 25 is the year to go, is because they were expecting inflation, and they were. But the reality of it is we are fighting inflation. We're trying to get inflation down in most instances. So it is like it's the real estate community thought that inflation was going to be there. They've been buying into this idea that there's going to be more demand. There's going to be faster growth in the U.S., and that faster growth obviously gives rise to inflation. But then we've done all these things to tame inflation, which is to slow growth.
I'm not sure what you've heard on the inflation front, but from the last year or so, what I've heard from the business community is that they have been expecting actually that we would eventually get lower inflation, and that would be good because that means that the interest rates are going to begin to come down slowly but surely. So what's happening now, and if you hear Powell speak, basically he's saying this, that the uncertainty that's being caused by the tariff environment is making him take a pause on whether or not he cuts interest rates because now he's uncertain about the path of inflation. If inflation had come down constantly and we were sure of the path going forward through the end of the year, we would have had an interest rate cut maybe earlier this year, or we would be more sure about an interest rate cut in September, right? The thing is that the uncertainty that was added by the tariffs is what, if you hear Powell's remarks, it's what's making him take a pause on the data.
But with due respect, that's a little bit backward looking. Look, Powell's saying that because he's setting himself up to be able to go either way. And I totally get that. That's what the Fed chairman's supposed to do. But you cannot blame the uncertainty on whether or not he should or shouldn't cut interest rates, because if you go with the idea that the tariffs caused the uncertainty and the president was elected in November of last year, why didn't Powell lower interest rates in any of those prior periods? There was no uncertainty there, and he knew that things were continuing to inflate. So he held the interest rates high to tame that inflation. Trump comes in, he's still trying to tame inflation. He's not changing course by leaving them where they are. He's actually doing what he had been doing. He cannot use uncertainty as the reason that he didn't change course, because he's been on this course for the last 12 months. The real estate community's been screaming the top of their lungs since the fourth quarter of 22 that interest rates need to come back down. And everybody's like, yeah, but everything else in the economy is blowing.
We discussed this last time. Okay,
Yeah.
so what happens if we have a still relatively healthy employment market, as was, from the data from the Washington Post, and we come off of a period where home pricing appreciation has been tremendous, rental rate appreciation has been tremendous, right? If the Fed decides to start cutting rates earlier than necessary, and the employment market's still holding up, then you get a reacceleration of inflation, right?
I agree.
And so we have just begun to see the weakening of the residential market at the beginning of this year. Finally, we're getting some weakness in that, the general homeowners are not going to like the fact that the home prices are trending down.
And we're talking like nationally, or are we talking Florida?
Nationally, and as well in Florida. If you look, some of the worst performing markets in the nation are Tampa Bay, like all of that area of Florida, which had 60% home pricing appreciation and over that, right? So if the Fed had decided to cut rates late last year, with a very healthy employment market, with still increasing home prices, we could have caused another spike in home pricing appreciation, which, if you look at the inflation data, home prices and housing costs are the biggest piece of inflation. They're the biggest piece. So if you reaccelerate that, you're gonna drive inflation back up, right? So that needed to be tamed. Now, we were going to get to that place in April, and we were getting there, but then the tariff talk came in, and now there's greater uncertainty, and we have yet to see more significant weakening in the employment market, which, as again, the latest data that has come in does not yet justify. And I'm not here to like cover Powell's remarks or make a point for him. I'm just saying, if you look at the data, the employment market remains relatively strong. We haven't seen we have seen the weakness, but not even a significant contraction in home prices yet. So nothing yet would justify bringing rates back down, because if we do it too early, we reaccelerate the inflation story. And at the same time, with all the uncertainty from the tariffs, we don't know, right?
No, listen, I 1,000% agree that I 100% agree with what you're saying. But then you can't then turn around and say, well, it was Trump's uncertainty that kept him from lowering the rates in April. It wasn't Trump's uncertainty in April. It was the fact that the employment market was still relatively strong. The stock market was rocketing. The general economy was on the right track and wasn't overheating, but it was sort of keeping up. And yes, there were segments of the residential market that said, man, we'd really like to buy a house. Can you lower rates? But also, we lowered rates, and the long bond market said bullshit. So it didn't even matter, because the rates got lowered, and then all of the interest rates.
I'm not, like I said, like those were Powell's remarks.
Yeah,
he's saying he is holding off because he has uncertainty about what the tariff situation is going to generate on the inflation front. So that is the reason the Fed chair has pushed back on bringing interest rates down, is because of that.
And what I said was he was rewriting. All I was saying is that Powell was just protecting himself. He was just rewriting history to be able to go either way, is what I said earlier. I know you're not here to obviously defend his remarks. You're using it in context, I thought, to say, look, even Powell said that Trump is slowing the economy, and this is what's happening. And I'm saying Powell saying that was just political cover from his perspective. He knew why he didn't lower rates, and I tend to agree that it was probably a good move, because if we can continue to control housing costs, that's a major factor in the PCE inflation calculation. So if we can keep housing costs and rents slowing, that actually helps to slow inflation. But the natural consequence of that is that growth will slow, which is why the consensus from economists is that 2025 is like a 1.5% GDP year or 1.8% GDP year over that.
And I can tell you what we're seeing on the ground. I mean, definitely here in industrial, we track all these submarkets here, and prices are still reaching new highs here and there, but volume has dropped significantly. So we haven't seen that price come down at all yet, which typically trails volume dropping. But there hasn't been that inflection point yet. And it seems like that's the trend across almost all asset classes.
It's the most frustrating thing for investors right now. The investors in the market right now are apoplectic for exactly that reason. They keep going in the market. They're waiting for numbers to come down. They're waiting. And I'm talking about in Florida, I'm not speaking nationally.
Same.
They keep looking in Florida, in all different regions of Florida that appeal to whatever their investment mix is. And they keep coming back after like 3 months saying there's just no product to buy at a price that I'm willing to tie my money up for on a 7-10-year deal. There's no real juice here. And so and this is primarily in the private investment community. At the institutional level, they're in a different mindset. They're playing a macro game. So the institutional community is looking at all this macro stuff and they're like, oh my God, I can't move right now because it'll make me look bad and I don't want to make a mistake. So they wait, and they've been waiting for 2 quarters now. But now the problem is on the institutional side, you have institutional investors that all have capital allocations, and their capital allocations are based on a percentage in direct investment, a percentage in stocks and equities and bonds and so forth. Equities now have gone bananas. So their real estate allocation, because they haven't bought anything for 2 quarters, is behind, and now it's behind out of their allocation mix. So the third and fourth quarter is going to have to be a buying frenzy for institutions.
So,
but what if there's no deals? Because the other thing too is like the lenders aren't foreclosing. They're not everyone's extending. Everyone's.
So I think it also depends on the property type, because like institutional investment has been relatively active on the industrial front, and even more so in South Florida.
But it seems like institutions are selling, right? Like Blackstone sold a huge portfolio.
And there have been institutions buying.
Yeah.
What
is that? Just a rebalancing of portfolios?
Yes. So a lot of institutions are trying to get out of office for some pretty apparent reasons, and they've been increasing their allocation to industrial significantly. Right. So because of that.
Why do you think Blackstone sold? They sold like a $300 million portfolio in Hialeah last year.
I'm not going to get into the specific. Like that probably it got to their horizon, their investment horizon, and that was it. Right. But there's been institutions that have been pretty active in buying, and in the first and second quarter of this year, and in South Florida. And now there's been a shift. Right. Like they were buying large bulk distribution warehouses. Oh, now they're taking a greater look at small bay warehouses. And, there's been a couple deals here and there that I've seen from big institutions where they're taking a look at small bay warehouses near the airport.
That's where all the big prices are right now, is small bay. That's like the major price per foot numbers we're seeing is all small bay.
Yeah, and it's a very interesting dynamic that, I have an article coming out next week on that. Basically, when you look at the pricing for bulk distribution warehouses, so anything 200,000 square foot plus, the pricing divergence has begun to happen where the empty warehouses are trading at a discount, the full warehouses are keeping steady. In the small bay segment of the market, the empty warehouses are beginning to trade at a premium. And I think we've talked about this before, and you guys are probably well aware of this, is they want that mark-to-market opportunity.
Exactly.
Right?
Yep.
So I'd rather have some tenant churn. I'd rather have a relatively empty or vacant small bay warehouse, even it's got to be attractive, period. But that way I can mark-to-market this deal and get the juice out of it. And we've talked about this in the past that, yes, the juice is gone, but there are segments here and there where there's always a little juice to be had, right?
Look, you and I've said this both times now that we've been on the podcast. It isn't. There's a macro look at the whole market, but at the end of the day, the deals get done on the street, on the site, on the property itself, right? So there's always opportunities. That's never in question. What's interesting to me, though, is as I'm listening to you talk about these small bay, where the institutional move to small bay, is they want to get out of office because it's so capital intense and it's so management intense and it's so risky. There's what's that Shakespeare saying? There's nothing really new under the sun. You get out of office and then you go into small bay warehouse, which is literally the most management intense, capital intense. You think about a big super warehouse, 1 million square feet or whatever. The mechanical plant to cool that warehouse is centralized. You take a small bay warehouse and now you've got individual packaged units for each one of those warehouses. You got individual plumbing in the walls. You got individual. So there's just so many things that can go wrong. It's like back to managing, an apartment complex.
Well, but there's
and the tenants are
but
smaller
the thing
and
is
not
that
sophisticated.
there's greater certainty on those returns than an office right now.
Oh, there's
And that's
totally. Different.
yes. So even though office was management intensive, and I'm getting into a management intensive section again.
You're trading.
At least I am getting a return for that management
Fair.
intensive sector.
You know, Felipe, ever since we moved into Bureau, my productivity has been through the roof. I mean, I might actually be getting things done for once.
The energy at Bureau just makes work fun. Plus, with 8 locations across South Florida, from South Miami all the way to Hollywood, there's no excuse for not finding a spot to get your shit done, Ben.
And we're not alone. Over 500 local companies call Bureau home. Everything from creative agencies and real estate firms to tech startups, law firms, and media companies. It's a melting pot of brilliant people, and we don't include ourselves in that category.
We definitely don't include ourselves in that category. Bureau really has space for anyone, whether you're flying solo or have a team. There are suites starting at 100 square feet all the way up to 2,000 square feet. They also don't try to lock you into long-term agreements, and everything is month to month.
Let's not forget the important stuff either. The coffee is top tier, staff is incredible, and has a very entrepreneurial vibe. It's not just a workspace, it's a place where work actually gets done.
That's right, Ben. So if you want to level up your workday like we try to do every day, check out Bureau. You might even catch us sipping some espressos between podcast sessions.
Or tequila.
Definitely tequila.
Tell Bureau the Built World sent you, and you'll get 50% off your first month's membership. See you out there. Cheers.
Later.
If your Instagram is collecting dust, so are your leads.
That's why we started working with Sage Marketing. And I gotta say, they're dialed in, Ben.
Yeah, they'll build out your content, help you with your brand voice, and even create custom reels for you. Stuff that looks good, authentic, and performs.
Whether you just need strategy, someone to train your team, or you're ready to hand it all over, Sage has packages for whatever level you're at.
And the best part, you can book a free 15-minute discovery call. No pressure, just a quick call to see where you're at and how they can help.
Hit up socialmedia.sage on Instagram or check the show notes for the link. If you're serious about growing your brand this year, this is the move. But one of the reasons why there's so much demand for small bay is because it hasn't really been built.
Yeah, exactly.
And so people are going into smaller spaces, and the inventory that has been built over the last 5-7 years has been all the 100,000 plus square foot warehouses.
I think there's some of that, but I also think that the pressure on retail rents is also driving small bay, because you think about a pottery studio. In a normal world, you would have put a pottery studio with a retail storefront. But you can't do that when you're paying $50 a square foot to be on US 1, right? So what do? You take your pottery studio and you need to go find some place that has, a $15 square foot rent.
Yep.
You magnify that times all of the businesses that need that type of facility, and then drive the small bay warehouse market and be like, holy cow, that was all the shopping center tenants 20 years ago.
That Ojos area of Aventura, you go there, like all the gyms that are located on warehouse product. And it's like, why? Like these would have been located on our retail strip center.
Yep.
Not anymore. And also, we're very undersupplied on the retail side too, right? So the undersupply on retail, undersupply on small
driving
bay,
rents up.
anything close to where that densification, and more so in Miami, where that densification has been happening, you're solid, right? So that demands, and if you look at our latest net absorption numbers, right, we're negative overall. Okay, a big chunk of that was Big Lots going out of business, and that's like 6 million negative nets in net absorption in that quarter. But most of the negative net absorption has been happening, again, that big bulk distribution, anything 200,000 square foot plus, and anything older than, let's say, 2010. Everybody's moving into the shiny newer product with 32, 34, 36 foot clear heights. So I can go higher. Maybe I do what the office players have been doing, where I downsize the total square footage, but because I'm going vertical, right, I higher quality, vertical, I can still stock up these many goods. So the overall net absorption that's happening is coming down significantly for that big bulk distribution. For everything else, the older stuff, there's some tenant churn, but there's nothing really driving a significant negative net absorption there, right? And that's because of these trends that we've been talking about. And that's why, like, if the institutions have been talking about these trends for 10 years. Like, it's not like, oh, it suddenly happened. What suddenly happened was, oh gosh, like I used to be all in on office, and the office market went where it went, And so now I need to do this quick reallocation of product. Where can I go? And right now, it's either you find a good retail deal, good luck, or you find a good industrial deal, right? So yeah, volume is down, but it has picked up. We had hit lows last year. It's picked up a little bit. And now what we're seeing is the listings for specifically the big bulk distribution product that's sitting empty, they're skyrocketing. So eventually, once this uncertainty starts to go away for this big bulk distribution product, if the net absorption turns the other corner, we get reacceleration in rent growth, then you're going to see more transactions on the other side, like the big bulk distribution stuff.
But when you follow all this back, it seems like, we saw an article, Deloitte said transaction activity is down like 31% year over year. And it just seems like that being on the ground, like across all asset classes. And it all seems to trace back to interest rates. Like real estate transaction activity seems like a direct tie to interest rates.
Right.
Is there anything else that will get us some deal flow? Like
there's an old Sam Zell quote that says that all the market supply and demand stuff that you do to determine when to build an apartment complex, or really to build any piece of real estate, just throw it out the window, because you should just be building when interest rates are low. Just keep building while they're low. And then when they go up, stop building.
Yeah.
It doesn't, the market will adjust to itself.
Yeah. So we're all just waiting for Powell.
Basically.
Yeah, which is what we've been waiting on for over a year now, 2 years. Like
Powell or the banks, because the banks could help if they start foreclosing and taking some of these projects back. But
yeah, and we've been talking about this for a while. That unfortunately, what would be great for real estate would be a recession. Right?
Oh, don't say that. Don't say that. That's never great.
Okay. Yeah. Great. No, but it's.
I don't know, Anthony. Were you buying debt in 08, 09? No, it was really fun. I'm telling you, it was a blast.
It's the only certainty that we would get right now for the interest rate story to significantly go down, because even if we begin to get rate cuts, right? Nobody's expecting 100 basis points in one go. It's 25, 50 maybe, right? So it's going to be a slow way down. And even if it's a slow way down, that's still 25. It's not going to make my multifamily deal pencil, or a lot of these deals actually make sense, right? So the only thing that would give a certainty of a significant downtick in interest rates would be unemployment significantly ticking up while we're getting a better story on the inflation front, right? And we're not there. The Fed has been doing its job, right? Like the economy has been holding up. So we hate to see it for real estate that interest rates are high, but they're high for a reason. Things have been humming along, right?
Yeah, and by the way, now that all of the senior citizens just got a basically 20% raise, all the baby boomers have no tax on Social Security under the big beautiful bill, right? So what are they going to do? Are they going to save more? They're just going to spend. So I'm predicting that third and fourth quarter is going to be an all-out frenzy. Acquisition friendly.
Even without interest rate drops, you think?
Yeah, people got to move.
Big prediction.
People got to move. People got to make moves. They got to deploy their capital. They got to put it, and the rest of the world is looking around saying, where are we going to put our money? And then they're going to be bringing their money here, and everybody's going to, and they got to put it somewhere. And they can't keep putting it all in the stock market, or the stock market will get way overpriced.
I mean, it is already over. But yeah.
Okay. So there you go.
So your prediction is third and fourth quarter is going to be good for real estate.
We're going to get to the end of the year. We're going to be like, we survived till 25, and it was so worth it.
That was the mantra last year, right?
Yeah, right. Everybody
survived till 25.
Yeah,
it's a good optimistic view.
I like to be an optimist. What's the point of being a pessimist?
Right. Yeah, exactly.
If I'm wrong, I'll be like,
I hope you're right. I hope everything begins to come back. 100%. Now, the thing is with a lot of seniors down here, for example, that 20% paycheck is probably going to go to all the assessments that they've been paying on the condos. And so there's always, somewhere where the cash has to be spent, unfortunately. And with the inflation that we've had over the last few years, given the fact that, Social Security payments haven't really been adjusted over the, for a long time. I mean, I think this 20% number that you're giving out is just bringing things back to where they should have been.
Interesting. Good. They're still going to spend it.
Yeah, no.
Looking through your report, Juan, I thought it was pretty interesting that international migration has taken over the main driver of population growth in Florida again.
Right. That was the story through the end of last year, which is the last data point.
Okay. So
Right.
not necessarily Q1, Q2 numbers.
No. So if you look at border crossings, which are an indicator, is the best indicator that we have on what's happening with migration, they're zero.
When you say border crossings, are you talking legal or illegal?
This is a mix. This is a
Yeah.
mix,
Any and
right? So typically they're between 150 to 200,000 a month, and we have been at like 10,000 to zero, or in the beginning of the year, right? So all the econ shops have been expecting what they're forecasting now is basically a significant slowdown in net migration. And unfortunately, and that's why I have that chart up there, is because we love in South Florida to talk about the fact that, we have all of these Northeasterners, Californians coming in and, driving our economy. Was a big piece of the driver coming out of the pandemic. But from 2023, 2024, we came back to the norm, which was international migration being the driver. And it wasn't just us. The entire economy, if you look at all major cities, over 80% of population growth was international migration, right? And that was driving, some people would say, that's driving a higher cost of living, et cetera. Look, in a lot of these Sunbelt markets that got significant in migration, we were seeing a lot of supply growth for multifamily, for residential, et cetera. A lot of that supply growth was coming in because we had relative affordable labor that made sense for that deal, right? And that most of that labor comes from international migration. So it's like attacking the international migration story right now, given the fact that we've had such a significant increase in overall construction costs, and attacking it when we've been, over the last 2 years, we've been relying on international migration to drive consumption, because a lot of these new migrants, they need to buy furniture for their new apartment. They need to buy all the things to get you established, right? And if you look at the data, international migrants, once they come in, they rent at way above average than the native population. The native population, 30% of them are renters. 70 to 80% of recent net migrants are renters, right? They just came in. They don't
know where they want to be.
They don't have
where they're gonna
savings.
be.
They don't have a job. They don't have a credit score. They can't go to a bank and get a loan on a property, right? So, and typically if you look at the census data, typically the migrants that come in, they have higher educational attainment, but they are on lower paying jobs. So if you come in and you're well educated, but you're on a lower paying job, you're gonna rent, because look at home prices. Like, you can't, even the native population can't afford the homes, right?
I was going to say, I don't think that you could just like pigeonhole just the immigrant population to not being able to afford homes. Nobody could afford homes.
Right.
The kids getting out of college can't afford homes right now. The kids that are 10 years out of college are crying that they can't afford
The
a home.
comment being is that even these educated migrants
Yes.
they just get the jobs that they can get, right? That are lower paying than the native population. They're less likely to eventually even get into the home market. So it takes them decades to start for that percentage of rentership rate to start come down significantly. So that was a big driver of the demand that we were seeing for apartments. That was a big driver for the returns that we were seeing on the apartment
Can
sector.
I just bolt onto that for a second? Because there's a corollary to what you're saying, but you're saying it from the sort of the migration adding to net population growth, right? Which is what's giving us growth. If we didn't have immigration in most cities in the U.S., the cities would be shrinking. Our birth rate is at a tipping point, right?
And even more so for South Florida, the concern is that and historically, right, the migrant.
He didn't let me do my bolt on yet.
Sorry, but like you touched on a very important point, which is they're the driver of working age population growth.
Right.
They're the driver of anybody that works in the restaurant, in like all of these, even healthcare, hospitality, everything. They're driving that working age population growth. Without them, in a few years, we have a contraction in working age population.
But you're still on the part of the economy that's like the rising middle class, right? You're taking everybody from that point. I'm also want to bolt onto that to say the other thing that driving the economy, particularly in Florida, is the international wealth that comes here.
Oh, yeah.
I mean, at the same time that you have this struggle and you can sort of paint this picture and say, you know, we have all of these immigrants, the reality is a lot of the immigration, particularly in cities around the U.S., is a positive in terms of what they bring wealth-wise, right? So, and that probably will continue. That's likely, I think, to continue.
Well, the hope is it'll continue. The thing is that it's more than likely the expectations and from the econ shops, not just that it will slow down. And when you look at, I've talked to a few condo developers, et cetera. We are a little bit on the supply side. We may be a little bit oversupplied right now in South Florida. In terms
so now
of
you're talking about you're talking now about the context of what's happening. I was saying as a broad measure over the last 10 years, they've played an important part in the economy. But again, let's not like just tie immigration policy to this slowdown. The Financial Enforcement Crimes Unit over the last 10 years has completely cracked down on the transparency of money. And what drove a lot of the wealth to come to the U.S. and in particular to choose places like Florida and other places where you could register with anonymity, that evaporated in 2015 in Miami, but then broadly throughout the United States by 2021.
Sure.
So this slowdown of wealthy people coming to the U.S. has to be like put at the feet
I mean, that
policy.
could be an impact, but I will tell you that also there's been a lot of Canadian money that's been transparent that was coming in. And the rhetoric generally with the Canadians has not been great, which if you look at travel data, et cetera, would indicate that things are coming down, right? In the long term,
I think the Canadians are the smartest people in the whole wide world. When the Canadians invest in the U.S. is when nobody else will. The Canadians always come like on the back end of a really good recession. They love to come to the United States right on the back end of a good recession. When the Canadians leave, you know the market's overheated. I think they're a great barometer.
Also the Canadian economy hasn't been doing great. Unemployment is up. They're about to hit a recession. So
I get it.
There's a bunch of factors that are happening all at once. And from my point of view, we don't need more uncertainty added to the environment. That's generally it.
That's why I'm taking a very positive outlook. Just definitive. We're going to have a
great.
We're going to have a good back end
of the
year.
Well,
hey, to that point, I saw on Juan's graph here, she said transaction activity appears to have bottomed out in early 25, and I see the chart across all sectors: industrial, office, retail, multifamily. The transaction index, it looks, I see that uptick kind of in Q1, Q2 of 25. Yeah. We don't really see it on the ground yet, but what is that data based on?
Right, so that's actual sales transactions.
Sales transactions across.
That's for South Florida.
Okay.
So there was an uptick through the beginning of the year. We'll see what the data says.
Is that carried through in Q2 as well?
In Q2, what I've been tracking, because now I shifted my role, what I've been tracking is on the industrial side.
Got it.
Through Q2, things have been relatively okay on industrial.
Anthony, what are you seeing like nationally? Does that trend sound right to you? I mean, you're optimistic. Do you think transaction volumes bottomed out and we're starting to see that uptick?
Oh yeah, no, I think the uptick is definitely, if you look at the RCA data or any others, the transaction data, it depends how you look at it too, obviously. If you look at it on volume, it doesn't always tell the story because a couple of big transactions can skew it totally. The volume number, which is what most people report.
That one is it volume or counts?
Transaction count index.
Yes.
Yeah. So that's a better, if you think of it that way, that's a better barometer, if you will. The count, because it's pure, it's more pure.
And that's actual brokers making deals.
But then it also tends to be a lot of smaller deals. So when the small market comes back, that index looks really positive because it's based on the total number. So when the small market stuff starts to happen, then that number spikes and you're like, oh my God, it's roaring. But really, in the aggregate, that 20% spike might have only affected the transaction volume by 5% or 3%. So you kind of got to look at both.
Yeah.
I would say that there's activity's up over last year for sure.
People are sick of sitting on the sidelines.
Yeah, and also just like Juan said before, some people get to the end of their fund mandate. Some people have a life expectancy with their investors, or they need capital for other things, or they lost all their money in crypto and they have to replenish their bank account.
I mean, if you held on till today, Bitcoin has been
right. It's been great. I was on the phone with with one of the investment managers the other day, and he said to me, it's crazy because I was talking about the bond market at the end of last year, and I just said there's no place. Everybody's building in all these interest rate cuts, but I don't see it. I think their bond market's going to hold, and I think we should have less inequities. And he goes, okay. So then he said to me just recently, last week or two, he said, you looked like a genius come February. And he goes, but by April, you look like a complete idiot. And he goes, and then by May, you were a genius again. And he goes, and now you are an idiot.
Yeah, it's that volatile.
Back to the roller coaster.
Yeah, exactly. Something we haven't touched on is multifamily. I mean, I'm seeing in South Florida, like development sites are popping on the market left and right because these guys can't find equity for these deals to develop. No one's breaking ground. I mean, we're talking to GCs and construction companies, and everyone's looking for work. Architects are looking for work.
Yeah. Let's not forget this has been going on for like 24 months because really since interest rates came up at the end of 22, everybody started to figure out whether their deal was going to work. And some people got out of the ground but some people didn't. And those that didn't, a lot of them were like, well, I'm in the entitlement process, so I've got a year or two to worry about it. Well, now they're out of the entitlement process. Their year or two is time's up. And so it's kind of like, what are we going to do? The reality is that maybe that land pricing will adjust, or maybe they'll just wait until the market gets back to that point.
Is that a national trend as well as multifamily development? I don't know, Juan, if you're still paying attention to that.
Yeah, no, 100%. Look, construction starts have been down for multifamily generally. The one market that has been the exception, I have that chart in there, has been
Jersey.
Miami. No, Miami has seen construction starts go the other way. Some big projects towards South Miami. But still, like the story is that construction activity, interest rates, land costs, construction costs, right? So we have now a 50% steel and aluminum tariff, right? That went up significantly from 2025. So steel and aluminum, more expensive now. So construction costs, higher. You are also the immigration story, a hit to construction workers, right? So in general, the expectation that maybe construction costs come down, no, they're gonna either stay flat or continue to go up. Land costs may be the only thing that budges, but we'll see because.
But it's such a small piece of the stack,
right?
Like,
and
honestly,
and sellers haven't been really willing,
and the banks aren't
and even more
pressure.
so here in Florida, when now the sellers for multifamily sites are trying to justify even higher pricing because the Live Local Act justifies higher density, et cetera, et cetera. So the land side maybe not, and then interest rates we just talked about. Who knows?
Yeah.
And if they come down slightly, right? Unless we get a significant unemployment rate, right, which is just bad, and then generally better for real estate. And
I will say this: I think a lot of the real estate community didn't think that it, had the conviction that interest rates were going to be higher for longer. And they knew it, and we sort of
100%,
dealt
and
through
that was
it and everything.
That was the issue. Yeah.
And I think in April they were expecting that cut.
Yeah.
Right. And so it's. Now everybody's really pricing it in. So what we're seeing is we're seeing a lot of activity.
They're pricing in the future rate cut?
Yeah.
Okay.
So that what's happening right now, I think it's July and August has been sort of a busy, active season to tee everything up, thinking when that rate cut comes, I'm going to execute on my refi, on my whatever. And then if that doesn't happen, everybody's going to be really
And how
upset.
has this happened historically? Because when you talk to guys that have been in the business for a long time, they're like, oh, historically, interest rates today on a,
they're normal.
They're normal.
Right.
But how do you get the market to readjust to that? Does someone have to eat shit to start making that feel normal again? How do we get to that equilibrium?
Yeah, there's going to be losers, right?
Right.
The
Someone has
people
to lose,
that bought in 22, maybe multifamily, and eventually they'll realize, hey, I'm not hitting my numbers. I have to sell. And, I can't sell at wherever the heck I can justify,
The old guys that have been through it will tell you it's like
30%.
This. It's
Boom.
you remember that point at the dodgeball game when the entire other team had all the balls and you were just standing out there naked with no defense? That's how it feels when you're in that. It's just like a bombardment. And then somebody just goes give it the keys back.
Yeah.
And then it rolls. But we're not there yet. I don't see that.
But I mean, we had one interest rate cut, right? A little while back. The 10-year didn't move.
Right.
Are we gonna, if we get another one, is the 10-year gonna move?
That's the big question. And you have big JP Morgan, et cetera. They've come out and said, look, the 10-year is probably staying at 4.5. even if we get a rate cut.
And is that a
It's not
function of
gonna-
our overall debt burden now as a
That's a big-
country?
yeah,
Because
right.
that's the scary one, right?
Right. So
Once-
you have to have an attractive yield for the debt burden to continue to get. So it's a very complicated. So even if that's why I'm saying, like, even if we get a 25 basis point rate cut, what happens with the 10-year? Does that really impact the 10-year at all? And then does that really impact any of the interest rate environment for real estate? Like,
I think that it isn't really that complicated. I mean, it is in the way it's traded, but at the end of the day, it's about sentiment. The 25 basis point cut is already priced in many ways priced into what everybody's doing today because everybody feels. But it was in April too, and then that's what caused the whole disruption around the fact that it didn't happen. At the end of the day, everybody's sort of already pricing that into what they're doing. Whether the bond market reacts to that positively or negatively is going to, all these other factors come into play. All of the other forward outlook factors come into play. And the bond, that's the great thing about letting the market decide.
Yep.
Because the collective market, it's better than having some wizard in a tower that can move a number and then the whole economy moves. I actually applaud the fact that we have a system that reacts negatively to just one person deciding this is the direction of the economy. I think it's great the way we have the economic system functioning that the bond market will tell us. And so, I think that he will probably have pressure to lower it, and whether he does or he doesn't, the bond market, the market will decide.
yeah, and look, he says he's data dependent, et cetera, et cetera.
Yeah.
So we'll see what the data continues to tell us with tariffs actually feeding or not into inflation. The unemployment rate, is it going to eventually start ticking up by September? Who knows? So there's all these.
By the way,
data
that
variables.
unemployment rate, I feel like is bullshit too, right? Like, where are they getting these numbers from? Like,
Well, I mean, look, there's always adjustments
I'll
to
tell you
the
what we did.
employment
Exactly,
data,
that's what I'm
right?
saying. It's
And there's seasonality to it. So some of the seasonality made its way through this
We
past number.
we
but,
cyber
yeah.
hacked the Chinese and we took their method of employment data compilation and we imputed it on the U.S. It's been great.
it's unreal.
We're using the Chinese method.
Yeah,
So
there you go.
I maybe I have the chart there, but look, I think we went through this same environment in 23. And in 23, there was also an expectation from the market pricing in rate cuts that in more significant that did not end up happening in late 23 or throughout 24. And everything readjusted, and what did we see? Very little transaction volume, softening of fundamentals, right? So if the market has to reprice or reestimate its probability of rate cuts, then maybe people are pricing in something right now, but the actual trade execution still doesn't.
This episode is brought to you by Built World Advisors. Yeah, that's us. We're not your typical commercial brokerage. We combine deep market knowledge with a media platform that actually connects to people doing deals, the developers, brokers, architects, and attorneys.
Let's not forget the investors, Ben. From warehouses in East Hialeah to off-market gems in Allapattah, we help you find value where others aren't looking. If you're tired of waiting for opportunities to land in your inbox, let's talk.
Built World Advisors, real estate for the people who get shit done. You can check us out at builtworldadvisors.com. One thing I noticed in your graph here, cap rates have expanded the most for office, and that's like almost at a 7 cap. I think you got industrial, multifamily, and retail kind of hovering around the six number, 5, 7, 5, 6. You don't track hotels because hotels I think have the craziest cap rates.
Yeah, we
We're
do.
at like 10 caps
so
for hotels.
I leave that to our hospitality expert Chantal Wu. That maybe one week that she's down here presenting, she can come to the podcast. Yeah. So she covers hotels.
Hotels specifically.
Yeah.
Why is that just too nasty of a sector to cover?
I think it gets to the point where like we're covering too much.
Sure.
So
There's only so many things you can fit in your head.
Well,
Yes.
I asked because
I'm going to bring my hotel specialty practice guy, Mike Daniels, down next time.
Yeah.
We'll sit her next to Wu and we'll see what happens.
no, it's just interesting because I see like specifically in South Beach, there's a ton of hotels losing money right now.
Yeah.
You know, interest rates going up, RevPAR is coming down, variable
and there's still some supply coming in.
insurance way up. So
Yeah, and the whole international travel, like, you know, the domestic travelers going international, and the international traveler, like the Canadians, they would have come to Florida, but now they're skipping Florida and they might be going to
The
Mexico.
strong dollar slays the hotel industry. Like, you got to look at the strength of the dollar in the economy. And over the last 2 years, the dollar's been so strong that both sides everybody in the U.S. is like, hey, let's go to Europe and Greece because we have the strong dollar, and all the international people are like, we're not going to go to Miami and spend $2,000 a night on a $600 night hotel.
You also got to see what happened. Like coming out of the pandemic, like Miami was it. Right?
22 was the peak, yeah.
Right, and no one had anywhere to go but Miami, and we were the only ones open in this country, essentially. So people were coming here. RevPAR went up significantly, and now the consumers rethinking the whole thing. Like, why am I paying this absurd amount of money for going to Miami again? No, the options are open now, and I can go all these other places, right? So that roller coaster happened a little bit earlier for the hotel side.
But it's weird. It's still this like extend and pretend thing because these hotels are losing hundreds of thousands of dollars on EBITDA annually, but the banks still aren't foreclosing.
Well, I mean, you gotta like the bank doesn't want the keys.
Of course.
That's the whole look.
Yeah.
I used to be in underwriting. Like all we do is we sit behind an Excel sheet and we get all the information, the financials, et cetera, the rent rolls, we plug them in. Oh, it looks good. It doesn't look good. We don't want to be managing, like the banks don't want to be managing properties. Like that's not their thing, right? So the only option that they really would rather have is like, hey, let's find a buyer for you and see if anybody's willing to buy.
So we just got to wait till these owners lose so much money that they're finally willing to just take a price and run.
Yeah.
Because without the banks...
And that's probably going to happen in... various property types, like we were just talking about. Like there's got to be a loser, and at some point it's got to give. Right?
I mean, I pulled up transaction activity for Miami. I think it was just South Beach from year to date, and there's been one hotel trade, one. I mean, it's crazy. And I've looked at probably 10 deals, and out of the 10, I would say half were negative NOI. In 24, and it's just crazy that more haven't traded, but the sellers are still holding out for these big numbers.
Well, you say holding out, but I mean, if you're trending negative, what number do you put on it? Whatever number it is, it's scary, right?
Yeah.
And then the sellers go, well, that's not enough.
Yep.
Okay. Well, if you don't have pressure from the lender or
that's what I'm
pressure to
saying.
sell,
Yeah.
Exactly. If you have the equity and then you can hold up,
just keep feeding it.
Right.
But it'll be deal by deal. Like some will break.
Yep.
And again, a lot of times the pressure starts, and we talked about the dodgeball game, right? One of those dodgeballs that are coming at you from both directions is the bank pressure. But if the banks are much more cautious and they go, well, we're all in this boat and what am I going to do and whatever. But then the banks started to realize they could lay off. The lenders were selling the notes in the background.
Yep.
And normally when that happens, if you have to take a really big discount, then you say, well, I'm going to foreclose. But they weren't taking discounts. They were selling notes in the background at par.
Yep.
So then they were able to basically trade off liabilities in the background of the trading of the debt. But now the new buyer, because normally what happens when that occurs is the new buyer comes in at a much lower basis and then forecloses because they've bought the debt down and they've got equity spread in their debt buy. So then they come in and they foreclose. Well, if they buy at par, they're back in the same crappy position that the guy they bought it from
I can't believe people are buying at par, by the way. I've seen that recently, very specifically in hotels, and I couldn't believe that someone would buy a note at par.
Yeah.
Like, even like a semi-performing note. It's really weird.
But what's the LTV on that?
Probably like 70. I don't know.
Right, that's the assumption that like
there's enough spread there.
Right, that I'm buying, even though it might be at par, I'm still at 70% of what the value would have been if we're back up, right? So, that's the whole notion behind buying these notes from banks, et cetera. And then maybe these are not bank owners now. Now these are who knows who bought the note, right? And they may be willing to actually their strategy is I will take over the asset.
That's the dodgeball that comes at you from the left side when you weren't even looking. Like we had an investment group, I guess, about 1.5 years, 2 years ago, and they had done a whole bunch of syndications on apartment, multifamily, and they were brilliant deals. I mean, like they were buying value add deals, and they were putting a bit of capital in, and then getting a nice price increase, and either financing out or selling it. Most of them they sold for good returns very quickly within 2-3 years. And through COVID, they just went on a crazy buying binge, and they bought a ton of assets, like 25 assets. And then rent growth didn't happen. And then the interest rate, they had an interest rate caps, but now the time was ticking and their interest rate. And then all of a sudden, they put together like a rescue capital stack that came in and recapped the entire portfolio. They didn't have to foreclose. They didn't have to go through all that. Like, there was enough. There's still a lot of equity out there. There's still a lot of money out there.
Well, that's the biggest.
So the dry powder might not be coming into it might have raised, the transaction volume a little bit. but the dry powder has been targeting debt deals.
Or pref equity deals.
So
Yeah.
that's all like higher interest rate. Like you get a much higher interest rate now, and you still get 70% LTV or maybe lower. So that's so low risk for such a high return. Why would I invest directly in the equity?
And not only that, you don't have to have any specialized professionals that know how to do anything about the real estate.
Anything.
I just need to
There's
hire
a spreadsheet.
I just need to hire a bunch of bond nerds, and
Yeah.
I trade it.
Yeah.
And I don't have to get my hands dirty. I don't have to collect rent. I don't have to build anything or buy anything or clean anything or whatever. And so that's the first where it goes. But eventually, somebody has to take action. That's when the dodgeball game gets interesting.
Yep. Pref equity is
Can
really
we
big.
call the episode Dodgeball?
Yeah, I'm into it. So you guys, Graz is optimistic for second half of 25.
I am.
Juan, what's your prediction for second half of 25?
Look, I think
By the way, next time we should start betting on this.
Yeah, we should,
Yeah,
right?
we need to keep notes.
the award is a nice bottle of whiskey.
That's a good. I like that.
So I think the
Blue Label.
it goes back to what we spoke about at the beginning of the year. Like, if we get clarity, if we get certainty around the trade deals, which it's happening in some cases, then things will start to look better eventually. My expectation for the end of the year for industrial specifically has come down. And for apartments, it's also come down because a market like South Florida, which we rely on international migrants occupying these units, like I've heard from apartment managers like, hey, the units are vacant, completely vacant. We get there, they're just vacant. They left, and you can't do anything about it. They went back to their country, right? So that's a headwind for multifamily.
You've heard this from a lot of folks here?
Yeah.
Yeah?
So, and look, it's not, a lot of it is not the 4 and 5 star high quality product. A lot of it is, the mid-range, lower range type of product. But that creates a drain on overall demand and occupancies, et cetera, which drag everything down. And we already were overbuilt on multifamily. So that is a drain to multifamily. On the retail side, the slowdown in consumption, the higher interest rate environment, all of that hits the consumer and the retailer. And the tariffs are hitting some retailers because a lot of the goods that were coming in. It isn't just tariffs. It's certain things like de minimis exemptions, right? So de minimis exemptions were for lower value Chinese goods that maybe you'd put them on an airplane and they would get shipped over in no time. They were completely exempt from any tariff, right? So they come in through the airport, boom, I'll
That's
put
the
them on
Shein.
my
That's
shop.
the Shein thing.
Yeah. And a lot of smaller shops were also relying on that, right? So that went away. So on the retail side, some of these retailers are getting hit. The consumption story isn't that great, so they get hit. And the office story, we are holding up relatively better because we don't have an oversupply of office down here. But when you look at office using employment growth, the fact that that's down, like flat to negative, doesn't really give me a positive indication for that story either. Most of the positive absorption that we've seen has been in New York. Everywhere else, it's not a great story, right? So
That's about to go in reverse. That's about to be decelerated.
Well, if he wins, right? I mean, it seems like there's a lot of money being thrown at Adams now, right?
I didn't mean to interrupt Juan's final prediction. Is he saying it's going up or down? Because I got a lot. What's
New
your
York
prediction?
specifically?
No. Where's the third and fourth quarter? Where's your
Flat to
third?
down.
Flat to down. Flat to down is the expectation. Look, all of the GDP forecasts have been revised slightly lower. The 10-year is expected to remain at 4.5 through the end of the year. So there's nothing. There's no tailwinds that I can really highlight right now that get us back into growth mode. The only thing that I can tell you is we still have a very solid unemployment rate, right? Still relatively low. Tariff on and off again environment, we'll see what that causes. For now, retailers have been buying up stock back to the levels that they thought they needed, right? But that doesn't cause much more of an expansion. For expansion in space demand, I need them to buy stock expecting growth on the other side from the consumer, right? So they're just coming back to the levels where they feel, the consumer's still going to expend at this level, so I'll bring that stock in and have that for now. But that doesn't create more demand, right? So the tailwinds, there's nothing that would indicate more growth. All I can say is flat to slightly down, because nothing's falling off a cliff, like has been the case for a while now.
Speaking of falling off a cliff,
Yeah.
when I listen to these, when I listen to these podcasts, I actually sometimes think that all the predictions we make, like once I'm listening to them, I'm already in the next quarter, right? All the stuff I said either came true or didn't or whatever. But the really interesting thing is to remember historically, like what we were going through at the time. Like when we did our first podcast in 22 or whatever, we were talking about COVID stuff. We had just come out of COVID and all of the things and the historical. I'm just glad we're sitting here on July 11th, not really realistically in the middle of World War III.
Oh, well, yeah, that's another side of the uncertainty.
Wait. And I want to bolt on to that. I'm going to bolt on to my own statement. I want to say for the record, like sometimes it's important to understand sentiment around the market, sentiment around what things are happening. Here's my general sentiment for the last 6 months. I love Israel. I love the genius of them. I'm sorry if that's controversial, but the fact that they have been able to withstand and withhold and be still like a light in the world is amazing to me. And I'm just glad we're still here.
Yeah, I
a
think
month and a half later.
I'll do a slight touch on that subject. So I think Netanyahu is a very smart guy. Look, I think towards the end of last year, like he's had internal conflicts in the country with the judiciary, et cetera, with mass protests in the country, and all of this turned everything around for him, right? So even though obviously there was an event that unforeseen completely, this is a good play for him to keep on pounding this entire story. So the Israel story is going to be with us for a long time, and the Ukraine story still there, still going to be with us for a long time. Uncertainty. The other piece, and for logistics specifically, is the Red Sea crisis. That has been ongoing for so long, with ships getting diverted from the Suez Canal, taking a longer trip out. And
Might have to send the B2s for another walk.
and last week the Houthis, whatever, they blew
I saw
up.
that. They filmed it really well.
Yeah, they're making films now, blowing up merchant ships.
I cannot tell the difference between AI. Houthis.
Exactly, that's the scary thing.
I can't even believe any of the Houthi stuff anymore.
Well, I mean, once you get the company confirming that their ship blew up, then
I guess there's that.
Those crises, like they might be put on like the back of our brains, but every little thing that continues to happen and stays on the platform longer and longer affects sentiment, adds to uncertainty, right? So anything that you can control as a country and reduce that uncertainty and provide some clarity for businesses, for the environment, for everybody else, that's a positive, right?
So you're thinking flat to down. When do you think's the inflection point? 26?
Well, quick question about just thinking out a little longer. We have midterms coming up in about a year.
I was just going to say, can I make a political prediction? I'm going to make a political prediction.
And so Powell's term ends when? In December or something like that?
This December?
It's soon.
It's soon,
yeah.
right?
Oh, wow.
So he's out. Trump's going to put someone else in there. Midterms are in next November. My sense, I heard this theory.
Come on, Felipe, just spit it out.
No,
He's trying to be politically correct.
No. So I heard this theory that that interest rates are going to come down because of the midterms. What's your sense on that? That for the Republicans to keep the power, stay where they are right now, that interest rates are going to have to come down, not significantly, but they're going to have to come down so that they have a favorable midterm. Thoughts on that?
That's really weird. It's kind of like meta, because I feel like what you're saying is, will they be able to control to get them down so that they can win the midterm? Or you're saying
Well, that they're gonna
Put
interest
someone
rates
in
down
that basically
is gonna
gets it down regardless of what the data's saying, just brings it down to help them politically.
Exactly.
So that is a huge shift from what has historically driven our economy and investment sentiment towards the U.S., right? So some people might not like it that there's a Fed board and a Fed chair that controls a number up and down. But there's people that like it even worse if there's a politically motivated actor that controls that Fed chair to move the number up and down, regardless of what's happening with the investment environment, the economy, et cetera, et cetera, et cetera, right? So I think whoever they get in, the Fed board acts like they vote, right? Like it isn't just one guy that you get in and that guy decides everything, right? So there's still going to be voting members, and there's two of them that are slightly vying for this role, so they're a little bit more dovish. But everybody else, which is the majority of the votes, they haven't really changed their views, right? So I think even if they get whoever they want in there, I will think it's going to be very hard that person will have a controlling voice and a controlling vote on what happens with interest rates. And at the same time, if that person does have a controlling voice and it is politically motivated, then I don't think that lowering of interest rates based on those decisions that are not based on the data, on the economy, et cetera, on the dual mandate, I don't know if that decision is going to be positive overall for our economy and for the investment environment. It's probably more likely we're going to have investment shy away from the U.S. as we become less, the Fed becomes less independent.
Interesting. I like that. Anthony?
It's really deep. I mean, here's what I'm feeling about it. It's a deep theory, but no matter who gets appointed, if what they do ultimately follows with a good economy, everybody will say, oh, the Fed was independent, it was a good pick, et cetera, et cetera. If they fail, they'll say Trump destroyed it. He picked the wrong Fed chairman and he destroyed the economy. So either way, it'll be like political crap for them to throw at one another. But fundamentally, I do agree, you don't want someone in that role that is influenced by any one person or party. You almost want the Fed chairman, to be like the Supreme Court. Like, we could do whatever we want. But the reality of it is you have to pick the right person. Otherwise, you could end up skewed, and we don't want that. A controlled economy like that is not what we're after. That's not us. So, I say independent Fed.
I can tell you, I'm from Venezuela. And there's one guy that's controlling everything.
It doesn't work out so good.
It's not
It
great.
doesn't work out so well.
Did you twitch when the chainsaws came out? The U.S. chainsaws came out? I love this. This is such a fun conversation. It really was.
I think we covered it.
I didn't get to my main political prediction.
All right.
Here's my main political prediction. Here it is. Maximum presidential volatility. He's going to be volatile for the rest of his term. There's going to be, if everybody's waiting for...
After the midterms, he doesn't need to care about even the platform that he got voted in on. Because as long as he does what he needs to do for the Republicans through the midterms, after that, what control? There's no election after that. There's nothing for him to really... So what do you think he's going to fade? I agree with that. You think he's going to fade off into the sunset and go play golf? No. I think he's going to do even more of what he wants to do, which is adding to that volatility.
I can't possibly think he's not doing every single thing he wants to do.
Well, I mean,
how can you maximize that?
If right now there may be a restraint based on the midterms where the Republicans in the Senate and in the House are concerned about getting reelected, and they may nudge him in a certain direction, after the midterms, it's whatever.
I don't think he's nudgeable before the midterms. That's true. I don't think he's nudgeable.
Then we're on this roller coaster for a journey.
Listen, I don't even want to say it like a negative roller coaster. I just want to say it is the nature of the market. We wake up every day and we see what happens in the world, and we're just part of what's happening in the world, and we got to adjust to it. It's all good.
Yeah. Buckle up.
Look, the only thing I would say, the market has always really liked some stability and some certainty. When you're not providing that, that's where
I don't know. I think high volume traders like this volatility.
Okay, like 1%. The guys that have always been making money are doing great. Yeah, fantastic.
Everybody has their political views, and everybody has their views on Trump personally, and they don't always align, right? But one thing is for sure is that he was already president for 4 years. So like we know we can get through it. It's not a problem. Like everybody, like a lot of my friends that are really Democratic leaning, like every day they wake up and they're like, "This is the end of democracy, and I can't live anymore." And I'm like, guys, it's not. Stop.
Just close your phone.
Chill.
Stop.
No, and look, it happened. It happened of 2016. Like people were like tracking every day what he was saying, what he was not, and unfortunately, I have to track it because the tariff situation aligns very much with what I do now, right? But that's the whole like mindset that I went into the second round of his administration. That like just wait for the roller coaster to come back up and down and up and down and up and down, and eventually you'll have a clear path. But I think that's why I'm solidifying back on trends that were important in the long term, which is, hey, if we want to do the tariff thing, let's do it in a smart way where we are making sure that Chinese goods aren't going through the other parts of the supply chain and still coming in, et cetera, et cetera, et cetera, because those are the longer term trends that we were, in fact, trying to tackle before this. Those are the long term trends that I'm still sticking to, where regardless of what happens, if the manufacturing doesn't stay in China and it goes to Southeast Asia, if it goes to India, those supply chain shifts were happening back in 2019 and were happening throughout the Biden administration still, because even Biden, you may say like he didn't do anything, whatever. Well, he also didn't touch the tariff situation, right? So that entire thing is both a Republican and a Democratic administration type of, like that's something that's going to stick around with us. Even maybe the tariffs are going to go higher or lower, et cetera, depending on the administration. But the geopolitical risks and the military risks associated with dependency on a country like China for all this supply chain, they're real, and they're regardless of who gets elected. So I think the supply chain story is still going to be Southeast Asia. India has been coming up lately, and Mexico, and that impacts the industrial world with what's been happening on the shifts towards, south, the Southern California markets, et cetera, having more opportunities there. I would just leave it at that, right? So at those long-term trends, regardless of whether Trump or not, or even going into the next administration, those supply chain trends are still going to be with us.
Cool. Well, thank you guys for joining us.
Yeah.
Love hearing both your views.
I can't believe it's over already.
Yeah.
I mean, we're an hour and a half in.
That's amazing.
Yeah.
Nobody's going to get to the end. Can we say some stupid shit at the end? Absolutely. I want to fast forward to.
We can absolutely say that's our favorite part of saying
Should we chill and drink for another hour?
Yeah, we could just cut it together. All right, so I'll close with this. There's this crazy, stupid show. I don't remember if it's on Netflix or on Prime, called Mountain Head. Did you guys see this?
No.
It's about 4 tech bros that have billions and billions
Is this
of
a
dollars.
new Steve? What's his name?
Steve Carell was
yes,
in it. Yeah,
he's in
yeah.
it. Okay.
It was a little bit like heavy-handed or a little hammy or whatever, but the main premise of it was that there were these 4 tech bros and they owned all the systems that were controlling the world. And they started to like unravel the world while they were away skiing on their week-long vacation.
Oh my God.
And the one guy gets like made the president of Argentina or something like that. Anyway, it was really like, it's like a farce. It's like watching a Mel Brooks movie. Like don't go into it thinking like, oh, Graz recommended this great movie. It wasn't a great movie.
Mel Brooks is great.
But it was
though.
farcical. No, Mel Brooks is the greatest. Mel Brooks is the greatest of all times.
Speaking of Mel Brooks,
Yes.
Blazing Saddles, one of the all-time greatest movies in the world.
Excuse me while I whip this out.
Oh man, that guy's a legend.
Yeah, he really is.
History of the World.
I couldn't wait for them to do History of the World Part 2.
Well,
like when I was a
they
kid.
came out with a series, you know that, right?
Yeah, I know. I watched. Believe me, I watched it.
Yeah, it was pretty good too.
It really
and
was.
He's like in his 90s and he was directing that.
Well, that was the greatest part about it. Was like the opening act of that series Part 2. He came out and basically said like, I didn't do any of it. Like these people all wrote it. They directed it. I basically just
put my name on it.
He is, Well, he's genius.
Yeah.
He's a genius. Like, serious.
All right, well, we're going to ride into the sunset on Blades and Saddles on that note.
Let's do that.
Have you watched it yet?
Dude, I haven't. It's been on my list forever. No.
I've been
clips,
telling
but-
this guy for 2 years, I think almost a decade.
Probably,
that
dude,
you
probably.
should watch Blazing
I gotta be
Saddles.
honest.
By the next podcast, you should have watched it.
Yeah,
like,
I'll
we're
watch
gonna make
it.
sure we're gonna
Make sure I
check
get some
that
quotes
box.
in there.
And
so
This
you
is
for,
the
know
worst.
why.
This is the worst when someone builds up something like so big, right? I think your age is going to handicap you a little. It's a little racist. It's a little sexist.
Come on, I used to watch.
But listen, this is the history. This is the beauty of it. Like Mel Brooks took the pain of like all these things.
He
and
offends
made them
everyone.
funny.
He offends everyone.
Yeah, and that's why Dave Chappelle's a genius.
Yeah,
For
that's
the
my
same
favorite
reason.
comedy. Yeah,
Dave
yeah.
Chappelle is my favorite.
I mean, I was in New York the last couple of days, and I went to a couple comedy clubs, and they're so soft now. And even some of the really hardcore jokes the comics said, it was crickets. He's like, "Oh man, New York's gotten real soft."
Yeah, the Gen Zers may be a little offended by
Yeah.
Blazing Saddles, but maybe it'll make them a little tougher.
Yeah, rough it up a little bit.
A daily dose of medicine. I like that.
Absolutely.
Well, Anthony, Juan, thanks for coming down again,
Yeah,
guys.
this is
was
so
an absolute
awesome.
blast.
It's so good to talk to you guys. The perspective you guys give is just amazing.
Great to have the brain trust in house.
Yeah, exactly.
We'll do it again for Q3. Absolutely.
Whatever.
Always a
All
pleasure.
right,
Love to
awesome
come back.
guys.
Thanks,
Thanks, guys.
Later.